Excel accounting practice problem, month 1 financial statements. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now entering transactions into it. If you have access to it, there's 2 tabs on down below, an example tab and a practice tab. Practice tab starting out where we left off last time, the example tab in essence being an answer key. Let's take a look at it now. We're now going to be looking at the financial statements. So we're going to go all the way to the right and update our financial statements after having entered and added so many different accounts. We started off with just the balance sheet. Now we're going to be adding the income statement, statement of the equity, given the fact that, of course, we have activity within it at this point in time. So we're going to go to the practice tab to do so. Let's do some cleanup work. I don't need to see any of the journal entries right now, so I'm going to put my cursor on the skinny right here. And I'm going to hide all the way over to the A, right click and hide that stuff. I can also then take my ending balances, take these ending balances here, copy those, put them into my beginning balances just like we normally have done, pasting them 1, 2, 3, deleting everything in the entry column so we have just a nice clean worksheet. I also don't even need to see the beginning and entry column. I'm just going to hide columns AK and AL so I can focus my attention on where it needs to be. So AK and AL, we're going to take those 2 columns, right click and hide them. Then I'm going to hide everything from here on over to where the financial statements are way at the end so that we got everything side by side so we can work on it at one time. So I'm going to just select all this stuff. Don't delete it. Don't delete it, but just hide it. Just hide it. Right to the skinny before the balance sheet. Right click and hide all that stuff. There we go. Okay, so now we're just going to update our balance sheet. I work from top to bottom on the trial balance. Many people will say that you got to do the income statement first, but if you have a well-formatted trial balance, I think it's easier just going from top to bottom. And so I'll show you that here. If you have an unwell formatted trial balance, or if you're kind of taking this from a piece of paper or something like that, then it becomes more complicated. But we can see here that everything should pull over, and I can kind of tie it out quite easily. So I'm going to start with the balance sheet here. We got the checking account and the current assets we did last time. We've got the accounts receivable inventory. Now we added prepaid insurance, which I'm going to say is a current asset. We have the short-term investments here, I'm going to say, is also going to be a current asset. So I need to add 2 new cells in this kind of area. So I'm going to take these 2. I'm going to right click on them and insert, and push these cells down. Notice there's also nothing in undeposited funds, but I'm going to add the undeposited funds just so it'll recalculate every time I look at the balance sheet. I wouldn't want to populate something with a 0 in it if I'm displaying it externally, but if you want to see the reports update each time and see how you can kind of automate that process to see what, in essence, accounting software will typically do, such as a QuickBooks or something like that, will add those line items, noting that accounting software can also give the added option of saying if there's a 0 there, hide that cell or something like that, with a database program giving you a little bit more flexibility. So let's add one up top here. Let's add that undeposited funds. Right click and insert, shifting the cells down. Also note that as I add the undeposited funds, I'm just going to put them all in the current assets. If you work on something like a QuickBooks account, they break it out further by the account type. Is it a bank account type of account or an other current asset? Is it an accounts receivable type of account? That's due in part to functionality of the software instead of just reporting purposes. For reporting purposes, you would think they would be reported up here in the same area, possibly combined into one account that would just simply be called cash and possibly cash equivalents. So let's say that this is just simply going to be equal to that 0 amount right there. I'm going to underline this one, font group underline. Then we're going to say that we stopped at the inventory. I want the prepaid insurance. We want the short-term investments as well. So let's pick up the dollar amounts, $12,000 in each. Let's get rid of these underlines for at least for that one. Underline. Adjust the sum function, which isn't quite picking everything up for the total current assets. Bring it on down. Picking up all the current assets. There they are. I can double check them by just selecting these ones and saying that should add up to 137, 196. It does. So we're good. Nothing new on the property, plant, and equipment. These two things we put in last time. So we're at the 90,500, which is the sum of these two. So that looks good. Total property, plant, and equipment. That gives us the total assets down here at the 227,696, which once again I could find by just highlighting these, noting this one's taking the assets down, given the fact that it's a credit, which is so easy to sum up if it's formatted in this way. 227,696 adds up to the 227,696. So I'm pretty confident about the accounts receivable. Let's move on over to the liabilities then. We got the accounts payable, we got the Visa, then I got the loan payable, the payroll liability, and the sales tax payable. Now note, I put the loan payable down here in the long-term section, but you know, in the future, we're going to have to break out those two to a current and long-term portion. So I'm going to actually move it up to the current portion. I'm going to make this 0 for now. And then I'm going to go back here and show you how in the adjusting entries, we can break out between the short-term and long-term portions. And this is what so I'm going to make that 0. This is what I would recommend oftentimes to do in the QuickBooks system, so you can make the data input as easy as possible and not be breaking out short-term and long-term, but just put it all into short-term, most likely, to start out with, and then do a periodic adjustment at the end of the month or year, which we'll work on at the end of the second month to look at those adjusting entries, what they will look like. So we're not going to do the adjusted entries currently yet, but we'll do them at the end of the second month so we don't have to repeat ourselves with the adjusting entries. So we're going to highlight these 3 cells, right-click, and insert some more room, shifting the cells down. I'm going to underline all these cells. We don't want any underlines there. We left off at the Visa. Let's just put our cursor on that one and do an autofill down. So there we got loan payable. We need one more down to the sales tax payable. I'll do the same thing over here. Just auto-filling that down. Picking up all the accounts then, like so. Notice we flipped the sign to have a positive number here because we don't want the credits showing up on our financial statements. Let's correct the sum function then to add up everything that is currently in play. And so there we have it. So we're at the total of the 77,373. If I add up these items, that adds up to the 77,373. We're going to call those all current, although that's probably not exactly true given the fact that this loan payable will most likely have a current and long-term portion to it, which again, we're not going to break out at this point in time. When we do the adjusted entries, we will take a look at that, breaking out the long-term portion from here to here. So we'll talk more about that later. No long-term liabilities then at this point in time until we do those adjustings. So this is the total liabilities. And then the equity, for now, I'm just going to sum up all of the income statement accounts, which will just be the negative sum to flip the sign of everything that is blue, whether it's blue and white or blue and blue, all the way down here. There we have it. And so if I sum up then the liabilities and equity, we match out. We got assets equal liabilities plus equity. So that looks good. Let's make an income statement now. Let's do the income statement. So I'm going to hide, or let's make another skinny column. Another skinny. This is going to be the income statement. So we just got revenue and expenses down here. I already know what's on the bottom line of the income statement because it's right there. So let's go ahead and hide some cells first. I'm going to put my cursor on the skinny column to the FY, right click and hide those cells. Income statement. Let's select like this many and then make that our header, make it black and white. Maybe make this a little bigger. And we start off with revenue accounts, revenue, picking up our revenue accounts, which are simply going to be the top 2 accounts. We got the sales revenue and the service revenue. I'm going to flip the sign on the dollar amount, negative of the dollar amount. Copying that down. That's going to give us total. We're going to say total revenue. Maybe should I make that capital? Probably. Revenue. Outside, we're going to put that on the outside to sum up the subcategories, sum of these two. Let's put an underline right here, font group and underline. Let's do an indentation, alignment, indent. Do this one, indent again, indent again. Then we're going to pick up the cost of goods sold, which would only be in play if you had inventory involved. Very important expense. We usually have a subcategory on the way down to net income called gross profit. And so we're going to pick up then the cost of goods sold. Let's put an underline there, and we call that gross profit. Gross profit. And so this is going to be equal to the 53,857 minus the 37,242. There we have the gross profit. And then we're going to have all other expenses, which I'm just going to call other operating expenses, colon. And so it's going to be another subcategory equals. We're going to pick up the expense, and I'm just going to copy it down from supplies on down to utilities. Enter. I'm just going to use my autofill to copy that down, supplies on down to utilities. And then we'll pick up the amount, which will be equal to the supplies, 37. That's cost of goods sold. Supplies, 700. And then just copy that amount down to the utilities. Same dollar amounts. Let's do some indentation for the subcategory, alignment, indent. And then we've got the total. So this will be total other operating expenses. Outer column equals the sum of these items. Let's do a double indentation in the alignment group. Let's put a little bit more room here so we can see all the words. And then put an underline here. And then we finally get down to what we call the net income, bottom line, which is going to be equal to the last pit stop along the road, which was called gross profit, to get minus the total other operating expenses to get to that net income of the 7,428, which matches, of course, the 7,428 down here, which we can also see by just adding these up very easily, given the fact that they're formatted in such a nice, clean, and easy way for us to work with these numbers to have the simplest formulas that are possible. Font group underline. Let's do a double underline on the bottom line number. And then I think it's formatted good. Let's do our blue and border formatting, selecting these. Put a border around it, make it blue. And then we might want to then do our statement of equity. One more statement of equity. Let's do a skinny line here. Skinny line. You won't always see this on like software like the QuickBooks software because it kind of tries to tie out the two by basically entering net income on basically the balance sheet. But the statement of equity will tie out the two and try to see how the two things are related in the double entry accounting system. So I'm going to call it a statement of equity. Now, there'll be a little bit different statement of equity between a sole proprietorship versus a partnership versus a corporation, but the concept is the same. We're going to start at beginning equity, look at the changes, mainly net income, and then disbursements, oftentimes draws or dividends, to see what the ending result will be. So let's increase some size here. Let's make this then black and white, as is our custom for the header. We're going to call it beginning equity. Now the beginning equity this is where the trick is, because this trial balance is as of the end date of the month, the end of January. But this number in equity generally represents beginning equity because the whole thing here is part of equity, is part of what the ending equity will be. So unless something was posted in here in the general ledger, which there's not, which if there was, you can go check the general ledger, this should be the beginning equity, which you could double check or tie to the prior balance sheet of the prior period, which in this case would be December of the prior month, to see if that was the same number, which it should be, and then you can go forward basically from there. If it's not, then you go into the general ledger to see what was posted to the equity account, why someone posted something there. Possibly it was some kind of investment, the owner put investment in, instead of making another account, they put it to equity, or possibly they put draws to the equity account. Those would be the most two common things that someone might post to the equity account. So we're going to say this is going to be negative of that 77,896. And then we're going to have a change to it. We're going to have an increase, which we could call this, so change in equity. So the change in equity, let's put a colon here, is usually net income plus any investments minus draws. So we had investments because it's the first month. So the owner put in money. So we're going to put owner investment. And that's going to be negative of that 65,000 that we're going to have right there. And so because it's going to be an increase. And then we also had net income, which we can pull from here, or we can see it from here, or we can see it at the sum of all of this stuff, credits minus the debits, 7428 for the income statement accounts. So we're going to say, let's do it this way. This is going to be net income from here. This will be equal to the net income. And this will be the change in equity. And the outer column equals the sum of these two, both increases. We don't have any draws at this time. Font group, we're going to underline it here. And then we're going to say this is going to be ending equity. I don't think I've been consistent with my capitalizations, but that's okay. We'll sum these up. There it is, 150,324, underlining here. So there we go. Let's call this ending equity, change in equity. So it's consistent, a little bit more consistent at least. Let's do an indentation here, alignment indent, and indent this one, alignment indent. Let's make this blue and bordered. So bordered and blue. And then I'm going to try to unhide my cells over here. So I'm going to unhide. This is going to unhide way too much stuff. But I'm going to unhide, right click and unhide. And then I'm going to try to rehide everything up to the point where we have our financial statements. Because I want to see the balance sheet. Over here, right click and hide those again. Hide all that stuff. So there we have it. So now you can check these out, and our check figures, of course, would then be, that this ties out to this, and then we see that our net income here, our net income is included in our statement of equity, and then our equity beginning balance change to the ending equity ties out to what is on the balance sheet for equity at this 150. Now, I pulled this 150 from the trial balance, you'll recall, by just summing up all the blue accounts. To tie this out to the other statement, we might want to take it from this equity over here. And so then we're still in balance, and you can see how everything kind of ties out, and how the financial statements in this way can kind of change as we add more data as we make changes to our trial balance over here. We can change the financial statements as long as we're not adding new accounts to the financial statements. That'll throw it off. The financial statements can still generate. You can see how an accounting system could basically add the accounts, like a QuickBooks or something like that, to the financial statements and generate those as you're basically adding new accounts to the chart of accounts when you're entering transactions there. Also note that in this equity section, like a QuickBooks will oftentimes roll in automatically the net income to the equity system and try to show you that by showing net income in the equity section. That's not traditionally done when you're talking about, reporting purposes, but they do that, and then they don't show you oftentimes the statement of equity, because that's the way they're going to try to link those two things out and make the closing process basically an automatic type of process to try to show people that in a more simplified way. So you kind of got to get used to that. And you also just need to note that from a reporting purposes here, we're basically showing everything that's on the trial balance in the financial statements in some way, shape, or form. reporting purposes, you might combine, like, these two accounts shouldn't be called the checking account and undeposited funds. We should group them together and just simply call them cash. Now, you can't really do that when you automate the creation of the financial statements, especially in something like QuickBooks, because they have to actually use two different accounts to record these two different items. So you can't even create a sub account in that particular case the way you can sometimes in other cases. So that's something that's a logistical kind of issue a lot of times with software and reporting purposes. Accounts receivable, they often report as a separate line item, which can be a little bit confusing as well. So you got to be careful with that. But other times you have the capacity, such as in the expense area, if you have too many line items on your trial balance and you don't want to show them all for financial reporting purposes, you could use sub-accounts in accounting software oftentimes to group things together. So for example, if I wanted to group these payroll items together in one line item, I can make a sub-account and then the two line items and group them together. So in other words, when you're making the financial statements, you don't always, want to use the exact same account lineups that are on the trial balance. And you could use various ways to group together items that you like to see on the trial balance for internal reporting purposes to when you make the financial statements, either by simply combining them together in something like an Excel, if you were to make the financial statements, or an accounting software. You might be able to get the best of both worlds sometimes by using sub-accounts, which allow you to collapse and expand sub-accounts of particular areas. Although, again, you still have problems where you have things like the checking account. I can't just put this under a sub-account of cash along with undeposited funds because there's different account types for, logistical purposes on the software. So oftentimes when you're running software, then it'll generate the financial statements automatically, but there's still a couple things that if you wanted to formally present it for a compiled financial statement and you want to clean it up a little bit more, you could do a little bit more cleaning up of them to get them in alignment for presentation purposes, but that might not be necessary depending on who you're presenting the financial statements to.